Before we get started, I want to just make sure that you can see the disclaimers here. We are new at this particular version of updating and educating folks, and so the important thing is that we want to protect your privacy and also allow you the opportunity to have dialogues as we move forward. If you can read through these really quickly, I would appreciate it, but definitely this is an opportunity for curious investors to gain a better grasp of how they might go forward in investing. And we're going to talk specifically on this particular video on how you go forward investing in stocks. William O'Neill is one of the people I've spent a lot of time studying. I've been in classrooms with William O'Neill. His book, How to Make Money in Stocks, is probably, I would say, the best investment book on how to invest in stocks. So I would encourage you, if you're curious about owning individual stocks, that's a good starting place. And I can recommend on future meetings with you all other options as you look to the future. And so I think we've covered this disclaimer well enough. And now I just want to, I'll just leave some charts on the screen as the talking point for us, and then we can move forward. And then if you want to talk to me after I kind of kick this thing off, we can unmute folks and go from there. So I'm still navigating. I usually have Amanda doing all the navigations for me on this thing, so I'm just trying to get to a comfort level here. The market is a great place to learn to invest. It's so much easier to invest today than any time in history. There's opportunities to invest with almost zero cost, and many people that are desirous in helping curious investors. And so what you have to, I think, address as you're thinking about investing and investing in specific companies is, why am I doing this? What am I hoping to accomplish? Because there is, I think, a amount of time that's required to invest in the markets. There's a opportunity cost if you're not sure what you're doing and you're making mistakes, that you can really do better by just investing in a group of stocks through something like an exchange traded fund or a mutual fund, rather than taking the individual stock risk of buying an individual stock. And so this is just a picture of a group of stocks or a market of stocks. And I would compare the market to your local grocery. Here in town we have Kroger, and Kroger is a market. It's a place for which you can go buy a variety of goods. I would say services, but I don't even know if they sell services. Maybe they do, but their goods definitely are often fresh produce, frozen goods, all sorts of proteins. They have tobacco and alcohol. They also have all kinds of random things that I've seen in there before. I think I've seen furniture. I think I've seen Christmas trees. I've seen just a variety of things in Kroger. So that's a market. And sometimes in that market, things are on sale and they're going down in price. And sometimes there's high demand and they're going up. Some of you might have noticed that recently with toilet paper. Like, who could have guessed the price of toilet paper would go up? You know, if that was a market for which you could participate in, and people out there would have not thought you were gouging them, you could have actually made money trading toilet paper, which is a weird idea, but that's a market. There's a market for which curious people can make money with things like, I don't know about toilet paper, but we could make money with, here's an old piggy bank that I had from when I was a kid. This thing could be worth something. I don't know, I'd have to go online and see, but there's a market called eBay for which you can trade things as silly as an old piggy bank, where you can find them at a discount and turn around and sell them at profit. So a market is just a group of things for which those assets are sold and bought. And so the stock market is just a place where stocks are exchanged. Some people have opinions about what they're worth, and others have varying opinions, and that's what makes it a market. And the most common market for which most people are familiar with is the S&P 500. It's essentially 500 of the largest companies in the United States. And what this chart is showing you is a 12-month view of the S&P 500. And the S&P 500 this goes back to August a year ago, and the price for which it was trading then was down just around, what is this price right here? 28.43. It's trading as of yesterday at 33.35. That's quite an increase there. That's about 450, 500 points, for which is probably about an 18% increase in value. That was not a smooth 18%. You had a smooth ride going on in the second half of 2019 and the first few weeks of 2020, and then all of a sudden it was like somebody fell off a cliff and you lost money. And so the why to invest is that you would like to get a higher rate of return with the assets that you have versus some other place that you might put them. There's not a lot of competitive places today. When I was younger, probably in my teens, there were places, savings accounts, for which you could get probably 3% in a savings account. That seemed reasonable at the time, but to know whether a rate of return is reasonable, you have to take into account a lot of issues, one of which is inflation. When I was a teenager, inflation is it's really the velocity or the speed at which the prices of things are going up on a regular basis. And inflation was probably running about 9%. So if my savings account was earning 3% and the cost of things is going up 9%, I was actually losing the difference, or 6%, on the value of my money. And so one of the reasons why people might invest is just to protect the value of their capital against things like inflation and taxation. I guess the second question that I'd throw out to you is, how much do you want to invest? Because everybody's got different risk thresholds. When you're starting investing, you're going to make mistakes. You're going to make mistakes whenever you invest. And so how much is probably best determined by how much you're willing to risk and how you're going to limit the risk that you're taking with that money. And in future weeks, we can talk about how to limit the risk that you're taking. But this week, I'm just throwing out to you, how much money are you willing to risk and how much you want to invest? For me, as a teenager, I chose to risk most of my savings. I just didn't have a big excitement about getting 3%, which was the going rate. So I took my money and put it at risk. The idea of this week is just even trying to get out to you all, where do you want to begin with investing? Because there's so many different perspectives we can take on this thing, but it's going to depend on where you want to navigate and go over the weeks ahead. Let's take a look at some ideas, and I'll throw these out to you as a starting point. I heard somebody say over the years, I'd rather be lucky than good, or lucky than smart. And I would say with investing, you don't want to be lucky, because lucky in investing creates bad habits. And if you're not good, or if you're not smart about what you're doing, those bad habits will lead you to lose a lot more money. Because what normally happens is, when you start out as a teenager, 20, 30, 40, 50, whatever that you're investing, you're going to invest a lesser amount of money. And should you get lucky and have something that happened purely out of luck, that you maybe don't even recognize as luck, you think you have skills, then you might be more inclined to invest a lot more money and hope for that same luck, for which you put a lot of more capital at risk. And so I would encourage you, before you really put a lot of capital at risk, is to fine-tune some principles and some skills. And then with those, you can begin to increase the amount you put at risk as you're comfortable with the parameters that you've put in place for yourself. So let's go and let's visit Keith Tyner as a teenager. And this is reality. I got some money. I don't even remember how much it was. Let's say $1,500 shortly after I graduated from high school. And I bought a little stock that would have been like the Google or the Amazon of the day. International Business Machines. I don't know if you out there are familiar with them, or if you have any interactions with them. As a matter of fact, when I graduated from college, International Business Machines was one of the most sought after employers out there, and it was the job to get. So today maybe it's Google or Amazon or someplace that is growing rapidly, but this was the one back in the early 80s. So I invested in this. Let's just see what happened if I said I invested in it in August of 1979. Let's see if we've got a picture of it. Let me find it here. So hopefully you all can see this. The August of 1979 is right here. Make sure I'm looking at this right. Yeah, that's right. And each one of these lines on this chart here are a particular day's stock price value. So on August the 1st, it was at a high of $70 a share and a low of $69.25. Okay, that is International Business Machines. And then let's just see what happens. I can click this one day at a time. Say I bought it on August the 1st, and I click forward on this for, let's say, 30 days and see what happens here. Because you have to pick a day to buy a stock, and if I bought it at that $70 price, we're just going along and seeing what I'm doing. And I didn't have anywhere near enough money to buy 100 shares, but that's the beauty of beginning and investing. You want to buy the best quality investments you can with the amount of money you have. Don't worry about the share price. Just worry about the money and the best quality that you can find. Because one of the mistakes I've made when I was at this stage was I spent time buying stocks that were low price, and that's just a good way to lose your money. Low price being those under $10 a share. So we bought at 70, and it's just zigzagging around here, and we're now almost with the end of my first month if I bought it on August the 1st. Can you see can you imagine the enthusiasm? I'm a new stockholder, and I've made it 30 days now. I'm to the end of August, and look at this. It had a high again of $70 and closed $70. It moved a lot in that first month, but it didn't really go anywhere. It just ended in the same place. But if you're a beginning investor, your inclination would be to watch it every day. And I watched it every day, and nothing happened basically after a month. So, you know, that we didn't have the internet, then I had to get up and look at the newspaper every day and see what happens. And so we're going through the second month of this stock. And we're still at the 12th of September 1979. Now we're at the middle of the month 1979, and now we're moving towards the end of the month. Look at that big day. It jumped back up over 70, and we're approaching the end of September. Now we're into October, and my $70 stock is now trading at $67.75. So I'm 2 months in and down $2.25. Probably getting bored with the process. What do you think? And we'll go just one more month to give you an example of a stock. Look at that one day there. It dropped all the way down below 65 here, and it did that all in a day. And if I happened to look in the paper at that price that day, I was probably wondering what in the world was going on. And it's bouncing around here like a ping pong ball, and now we're approaching the midway part of October, and we are at the Halloween scary season of October, and my stock price closed at $62.38. I am down exactly 10%. What do you think about that? If you have any questions, now's the time to throw it out about my first 2 months, or was that 3 months? August, September, October, yeah, 3 months of investing. Anything out there for me? Here's what you need to know. A 10% loss is going to take about a 12.5% gain to get back up. Okay, so from that 67 62.38. Let me just make sure my math is right here. Yep, 12.5%. So I lost 10 at this, and I'd have to get 12.5% to get back. That's the math behind investing, is your percentage gains go up that are required just to break even from losses that you take. And so to follow that math, if you went down 20%, it's going to take a 25% gain to get back to where you started. If you went down 25%, it's going to take a 33% gain to get back to where you started, just to get back to where you started. So as an investor, what you want to do is figure out and determine ways that you can limit the downside risk on your stocks. Okay, you guys as bored with IBM as I am, let's go look at another one. I'm going to take you through this morning my first 3 stocks, and then we can begin a dialogue next time on some other stocks. Here's a beautiful stock that I bought on that same fateful day. And again, I'm not recommending any of these stocks because they have, these are years ago. So here's one called NiSource. It, all right, boy, I didn't remember buying it at this price, but it was. If this is when I bought this one on August the 1st at probably, let's just say $15.75. Let's give it about 3 months. And we go through these quicker since you've watched the process. So I'm just going to get through August here, and you can watch how it trades here. $15.75 was our starting point. Oops, I got through August and didn't even, so August, we finished August right here at $16.13. So was that 38 cents I made on this stock in a month? So I'm feeling pretty good about it at the end of August. Now we're moving forward to the end of September. $15.75 starting place. At the end of September, I'm at 15.25. I'm down 50 cents after 2 months, which is all right. What's 50 cents amongst friends? So we get to the end of October. Again, it's spooky season and scary Halloween. I'm getting smashed on this one. I am getting massacred. It finished at $13.25. I started at $15.75. Is that right? $15.75 minus $13.25. 16% loss, probably a 20% gain to get me to break even. And I am getting an education on this stock by what we call the University of Wall Street. I've just lost a significant amount of my capital, and it is not feeling good. Let's see where I was. $15.75 starting point. We're going to go out to August the 1st of 1980 to see how bad the process was. A year later, my money is trading at $12.50 at the end of the 1 year. So I'm only down, a good 20% or more after a year. That is not how you make money in stocks. That is a sad, sad situation. And that's the reality of my teenage investing of my first, 2 of my first stocks. Let's see if I can find the other one. I should have probably saved you guys some time by doing this in advance, but I think this one's still publicly traded. Yeah, here we go. August 1st. So Kimball, do you guys know Kimball? It is a Jasper, Indiana based company, and I'm not even going to throw my stockbroker under the bus, but in 1979, what Kimball did is they made pianos, like wooden pianos, okay? Any of you all have pianos out there today? Are they wooden? Are they made by Kimball? I'm not even sure what Kimball does today. It looks like up here it says they make household and office furniture, no mention of pianos, but I bought a piano company, and evidently on the 1st of August in 1979, I bought it for $15.50. $15.50 sounds real similar to my NiSource investment. And so let's see what happened there. I'm going to get us through August real quickly so I don't bore you with the details here. There we are. I am making money in Kimball. $15.50 is up to $17.13. That's $1. What was that? 63. $1.63 divided by 15.50 is almost an 11% gain I made on this stock. It still didn't make up the losses on the other one, so my portfolio after a year is down. And let's go out a little further here. I forgot where I was at here. I was into August. Let's go into September. Started at $15.50, and I'm at $16.13 after 2 months. And then at the end of Halloween, or on Halloween on this year, I finished the year or the 3 months at $15.38. Now I'm losing money on this one. Well, there you have it. Let's go a year out. 8/1/1979. And at the 1 year mark, I'm $15.50. You're probably asking yourself, how did Keith fall in love with stocks if his first 3 stocks went nowhere or down? But let's take a look and go, oh wait, that's my starting, that's 1980. Sorry about that, guys. 1980, there we go, I made some money. It finished the year at $16.88, so that's better. That's not quite as painful as breaking even. So let's compare that now to a market. We're going to go to the S&P 500 and see what it looked like, if it was even a thing. And let's see. Yep, it was out there. And we're going to go to 1979. It was trading at 104, and we're going to give it, we'll speed it up to Halloween here. And it started that time at 104 and it finished it at 102. So it was down about 2%. So my 3 stocks, in order for them to have been a better investment than just the market itself, would have had to been up more than 2%. Or wait, was that down? Was that 104? Oh, we're only 3 months out. We go to the year. Sorry about that, folks. That's what you want to do, is you want to compare your performance of what you're doing. Yeah, I did much worse than just the market. Here we are, a year later, the market was up about 18% and my stocks were down. That was a tough way to get into the market. And what I started this call off with mentioning to you, you have opportunity costs and you have to decide how much energy you're going to put into it. So my 3 stocks would have done better in just a group of stocks rather than trying to own those individual ones. So that's my introduction to the market. And there wasn't anybody at all out there to really talk to me. I had a stockbroker that would talk to me that would never really call me. They just would take my money and say, here's a good stock to buy today. And they wouldn't really give me any strategy. So back in that day, there was just a lot less information available to invest, and the possibilities of how to get your skill set increased were very minimal compared to today. And so today, one of the tools that's now available is that the team at Kimball is motivated to help curious investors learn how to begin investing in stocks, and then coach you through the ups and downs of your decision grid and some great opportunities. But I thought a great way to kick this off was just to show you the reality of my first 3 stock trades and how painful of a first year it was. It was almost like paint drying when I could have actually had a pretty decent return by just owning the overall market. I think this is all I've got today. I'm about out of time. Are there any questions that any of you have out there for me today?
I've got one quick question, Keith. How did you stay motivated then after your first year if it was not great?
That's a good question, Amanda. I think the difference today versus then is just the lack of information back then, right? Like there wasn't an internet. I know that's hard to believe, but there wasn't an internet, and there weren't mass quantities of people investing, so there wasn't a good amount of information. Normally what I'd have to do is just pull up the Evansville newspaper. There was a stock market section in there, and then it listed the favorite stocks of the community in there, and then I could look at the stock price, and that was about all I could find on a daily basis. There's a publication at the library back then called Value Line, and Value Line would give investors, their opinion on different stocks. But for an 18-year-old kid, there just wasn't much out there to help me learn my skill set. So I learned a lot of mistakes investing in those early years, and just basically gave away my money, which is okay. You learn, that's what you do when you go to the university, right? You are giving your money away to learn things. I just gave my money to the markets, and the markets taught me through my mistakes. Does that help?
Makes sense. Yep. Thank you.
You're welcome. Any other questions today? I would say the last thing I'll throw out there to you today is that I'm going to go to today, and on this chart, reset to today. And one of the first things you need to look at as you're investing is to decide which direction the general market is going. And it's hard to tell just, here we are, this was yesterday right here. But if you look over to the left of this chart, it was pretty seeming directionally that this was going upwards over here up until probably around February 20th. And then something dramatic changed right there, and the direction changed. And there's some things as we get more time under our belts that I'll be able to talk you through where you can identify those things. And then there were some directional changes that took place right here. I think this is April 9th. Well, April 9th would have been the NASDAQ. This is April the 6th, maybe. Can't get, I don't have the dexterity. There we go, April 6th. So the S&P, there was a directional change that took place on April the 6th that was identifiable. But before you put money in the market, it's just worthwhile knowing which direction it's going, because the market will take your stocks in the general direction it's going. Not guaranteed, but probably 70 to 75% of the stocks are going to go in the direction of the overall market. So if you're deciding you want to invest right here and you don't know what you're doing, you could have lost a lot of money right here. And to your question, Amanda, if we said, what date was this? This would have been the day I absolutely would have quit buying, and it would have been probably selling by February 24th. Let's look at Amazon, because it's done a really nice job since then. But so Amazon's gone gangbusters. So it's hard. I'm gonna take this back a little bit so it doesn't look so easy to have stayed in this. I'm gonna go back to May the 11th. Yeah, so this makes this more realistic to what actually happened on, what do we say, February 20th here? This is the day I would have been getting out of the market, and this day I would have probably been getting out of Amazon right here. And it dropped after this day from 2088 low all the way down to this day of goodness. Don't try this at home. This is not easy to get that. There we go. To 1689. that's a 20% drop. And had you thought this was a good day to buy it right here, you lost 20% of your money. And so to say, you know, just to go back today and say, yeah, I would have held on to that, is not probably being intellectually honest with yourself about that, because it's it looks good on this chart right here because this doesn't look so bad. This was really bad and hard for an investor to stick through. So to your question, Amanda, I didn't have to go through quite those kind of drops during those first few years, but those kind of drops will leave you in a frustrated place if you bought at the wrong time. And I didn't even know back then to pay attention to the overall market with respect to my individual stocks. And so that's your benchmark, is, am I doing any better than had I just bought the overall market? Well, let's wrap up today with that. I just encourage you all to stay curious, to email me any questions you have for our next show. And I thank you for your interest. I think it's going to be a lot of fun encouraging you in your investment pursuits, and we can cover a lot of ground in a short period of time. So have a great rest of the weekend, and I hope to see you all next time.